Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, June 11, 2024. Hope you're having a fantastical day out there in the interwebs. It's a nice day here in Colorado. Got some storms coming around, but still sunny right now. So, woo, good. All right. Looks like the markets, looks like they kind of came out of the red where they'd been most of the day. The NASDAQ was in the green most of the day, but the S&P 500 managed to finish up the day with a rally and finish in the green. The Dow, unfortunately, did not. So that's too bad. All right. Well, if it is your first time watching Liberty Call, if you could give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All right. Let's go ahead and get into today's numbers. Dow Jones was down 0.31%, 120 points, closed at 38,747. S&P 500 was up 0.29%, 15 points, closed at 5376. NASDAQ up 0.88%, 151 points, closed at 17,343. The VIX was up 1.33% today. It's at 1291. Canada down 0.83%, Brazil up 0.77%, and Mexico up 0.02%. In Europe, lots of red. Germany was down 0.2%. The UK down 0.98%. France down 1.33%. The Netherlands down 0.37%. Spain down 1.6%, Italy down 1.93%, Switzerland down 0.57%, and Portugal down 1.41%. Russian exchanges both in the red again today. The MOEX down 0.25%, RTSI down 0.96%. And the overnights, the Nikkei was up 0.19%, Australia down 1 1/3, New Zealand down 0.4%. In China, the Shanghai was down 0.76%. The Shenzhen component up 0.07%. China A50 down 1.48%. DJ Shanghai down 0.2%. Hang Seng down 1.04%. And the Taiwan weighted down 0.3%. All right. So those are the markets for the day. Not that great, unfortunately. Let's go ahead and move over to the market recap, see what happened there. S&P 500 eyes another record close as Apple hits record high. Fed kicks off its meeting. All right. Let's get up here to my notes. The S&P 500 stayed on track for a record close on Tuesday, buoyed by falling treasury yields and a significant rise in Apple shares. Oops, didn't mean to do that. Where was I? Despite overall market caution as the Federal Reserve commenced its two-day meeting. Apple surged 6% to a record high following an annual developer conference where it unveiled an AI strategy that impressed Wall Street. The tech giant announced a partnership with OpenAI to integrate the ChatGPT chatbot into its products, which is expected to drive an iPhone upgrade cycle, particularly benefiting the iPhone 15 Pro. The yield on the 10-year Treasury yield fell by 7.4 basis points to 4.397% after a $38 billion auction of 10-year notes resulted in lower than expected yields, indicating stronger demand. Yields on 2-year, 5-year, and 30-year Treasuries also decreased following the auction results. The Federal Reserve began its two-day policy meeting on Tuesday with expectations that it will maintain interest rates in the range of 5.25% to 5.5% during its announcement on Wednesday. The meeting will also feature the Fed's updated dot plots reflecting its outlook on interest rates, inflation, and unemployment, with Fed Chair Jerome Powell's remarks anticipated to capture significant investor attention. And that's tomorrow afternoon. Additionally, the May reading of the U.S. Consumer Price Index, a key inflation gauge, is set for release, and that'll be on tomorrow. Signs of easing inflation could solidify expectations for future rate cuts, especially amid economic weakness, whereas a high inflation reading could reignite recession fears. General Motors saw its stock rise by 1.6% after announcing a new $6 billion stock repurchase plan. Meanwhile, Eli Lilly traded slightly above the flat line after its Alzheimer's drug, Donemab, received unanimous backing from an FDA panel. Overall, the market remained cautious but positive as it awaited key economic and policy updates from the Federal Reserve and upcoming inflation data. All right, so kind of a light day as far as news. I mean, I was scouring through the news sites looking for things to talk about or, what's on the mind of people today, and there wasn't a whole lot out there, unfortunately. So next up, a little bit on the bond auction. Stellar 10-year auction sees a surge in forward demand near record stop, through. All right, so let's see what happened there. The U.S. Treasury's auction of $39 billion in 10-year notes on Tuesday was highly successful, contrasting with the previous day's less than impressive 3-year note auction. The auction featured a high yield of 4.438%, which was 5 basis points lower than the previous month's yield of 4.4830%. The yield also stopped through the when issued by 2 basis points, marking the largest stop through since February of 2023 after 3 consecutive tails. Several factors contributed to the auction's success. The bid to cover ratio, a measure of demands, rose significantly to 2.67 from the previous 2.486, the highest since February of 2022, and well above the 6 auction average of 2.5. This indicates strong investor interest. The internal distribution of the auction was also notable. Indirect bidders, which include foreign buyers, took 74.5% of the auction, the highest since February of 2024 when they took 79.5%. Direct bidders were awarded 13.8%, a decrease from 18.7% in May, and the lowest since August of 2021. Consequently, dealers ended up holding 11.6%, the lowest since August of 2023. The immediate market reaction saw Treasury yields drop by 3 basis points to session lows following the auction results. This decline suggests that the auction was well received, alleviating concerns about potential buyers' strike ahead of the consumer price index. Despite the positive auction results, there remains a significant gap to close from the weaker-than-expected jobs reports released last Friday. The auction success indicates strong demand for U.S. debt, potentially calming fears about a hot CPI data or further economic disappointments. Overall, the auction is considered one of the best 10-year note sales in over a year, demonstrating robust demand and strong investor confidence despite economic uncertainties and the upcoming CPI data release. All right, so everyone's in a good mood today. Crazy, I know. All right, I got another article here from Zero Hedge. It's titled, "It's Not 2000, but There Are Similarities," and it was written by Lance Roberts of realinvestmentadvice.com. All right. In his analysis, Lance Roberts draws parallels between the current market enthusiasm for artificial intelligence and the dot-com bubble of 1999 and 2000. During the late 1990s, fears of Y2K and the excitement over the internet's potential led to a market frenzy. Similarly, today's market is buzzing with AI as companies integrate AI strategies to attract investors. This pattern mirrors the past when companies simply added .com to their names to boost stock prices. Roberts notes that the S&P 500 and NASDAQ saw significant rallies in the late 1990s, driven by a positive feedback loop where rising big-name stocks forced indexers and ETFs to buy more of them, creating a reinforcing cycle. Today, the same phenomenon is evident with AI stocks, particularly those like NVIDIA, which have actual revenues and earnings, unlike many .com companies that had speculative valuations with no earnings. However, the current market also faced risks reminiscent of the .com era. The concentration of investments in a few large companies makes market performance appear robust, despite only 30% of stocks outperforming the index. The reliance on these top stocks creates a mirage of stability, similar to the dot-com bubble, where expectations eventually failed to match reality. Roberts emphasizes that while AI companies today generate real revenue, that this does not eliminate the risk of a disappointing outcome. He warns that the current boom in AI stocks, driven by speculative hype, could lead to unsustainable expectations. The notion that trees don't grow to the sky applies here, suggesting natural limits to growth and efficiency as companies expand. The article highlights the historical lessons from the dot-com bubble, where initial excitement eventually collided with the reality of valuations and earnings growth. The current AI craze, though different in some respects, shares similarities with past market booms and busts. Whether this time is truly different remains to be seen, but caution is warranted as speculative fervor often leads to market corrections when expectations are not met. All right. So, yeah, the 2000 or the .com thing was a pretty big deal back then. All right. Last up, got an article from Mises Wire. What causes stagflation? And this was written by Frank Shostak. So let's see what he has to say. In the late 1960s, economists Edmund Phelps and Milton Friedman challenged the prevailing belief that a sustainable trade-off exists between inflation and unemployment. They argued that loose central bank policies ultimately lead to lower economic growth and higher inflation, a situation known as stagflation. Phelps and Friedman explained stagflation by illustrating how an increase in the money supply initially boosts economic growth. When the central bank increases the money supply, individuals perceive themselves as wealthier, leading to higher demand for goods and services, increased production, and reduced unemployment. However, as this newfound wealth dissipates, higher inflation expectations set in, diminishing overall demand and slowing production, which eventually raises unemployment back to its previous level, but with higher inflation. The economists concluded that while the unexpected increase in the money supply might temporarily stimulate economic growth, this effect dissipates once individuals adjust their expectations. To sustain growth, the central bank would need to continuously surprise the public with even higher money supply increases, which ultimately only leads to higher inflation without long-term economic benefits. Kind of like how they've been raising the money supply decade after decade after decade. I mean, our dollar is worth, I think, about 4% of what it was 100 years ago. I mean, it's very, very small. The fundamental issue with loose monetary policies is that they enable an exchange of nothing for something, diverting real savings from wealth generators to holders of newly created money. This process undermines the economy's real growth by weakening the savings and wealth generation needed for sustainable expansion. Stagflation occurs when the increased money supply leads to higher prices while simultaneously stifling economic growth. The severity of stagflation depends on the state of real savings. A declining pool of real savings exacerbates stagflation, while a growing pool might mask its symptoms temporarily. Thus, an increase in the money supply eventually sets stagflation in motion, making it an inevitable outcome of loose monetary policies. The visibility of stagflation depends on the underlying state of real savings. When savings decline, stagflation becomes more apparent. In conclusion, Phelps and Friedman asserted that loose monetary policies cannot sustain long-term economic growth and only lead to higher inflation, ultimately resulting in stagflation, which is where we're headed, folks. Woohoo! I'm excited, aren't you? Alrighty. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. Hope everyone has a wonderful evening, and I shall talk to everyone again next time. Adios.